Borough President Staten Island.
Present.
Borough President Bronx.
Here.
International Brotherhood of Teamsters. Here. Transport Workers Union.
Present.
District Council 37.
Here.
We have a quorum.
We start with a monthly report.
Okay.
Does everybody have a monthly one?
Yes.
Yes?
Yes.
Okay. Good? Have a good day. So if you annualize yesterday, everything is great. But we won't do that.
Magic wand.
Magic wand, fully funded, things will be spectacular. How about we look at page 3? Just to quickly level set everybody again. So we're the blue line, right? This is the GDP coming out of the recession. I would tell you that most people are starting to think that the worst is behind us and growth is, while moderate, as the Fed says, is here. And if you just thumb through the pages going forward, you see that that's in fact. Yep.
Byron Mead was on TV doing his predictions.
And
they're extremely positive.
that's
So let's share that.
Error of good news.
well, that's great.
Byron Mead, 100
And you can see on page 7 the unemployment rate, as we all know, is slowly coming down, ever so slowly. So it's a very different scene than it was, with the exception of page 11, which is housing still at the bottom, right? And housing ripples into jobs. And that problem is going to take a while, and a lot of people are spending a lot of time trying to figure it out, but time sort of marches on. But it's very different because what happened, again, these are January numbers, and in mid-December, the ECB flooded the European market with 3-year loans and sort of created the funding that made everybody feel really good about Europe and the crisis in Europe, so that I would tell you Byron's predictions are probably grounded in a good news story. The good news story, if you will, manifests itself on page 22, which is the VIX, which is volatility, which is people trying to figure out which way things are going. And again, if you look at where we were in the fall and where we are now, which is below 20, people are calm again. So now we have risk on versus the risk off position that we had. The Fed, although they keep saying it, people seem not to listen as much, says we're going to keep rates down for a long, long time. The surprise was probably the 10-year treasuries, which has gone up from sort of 1.9%, 1.8%, people are petrified, to like 2.25%, which is very, very fast, very, very much backing up. I'm sure we've lost some money in our Core Plus 5 portfolio. We'll see that in a couple of months. But that does translate itself into the risk on, which is stock market then has gone on fire. For good fire as opposed to bad fire, and people are taking risk again. You can see that back on page 30, which again is the Russell 3000, EAFE and emerging markets, all of which have gone nowhere generally but up since mid-December. If you look over on 32 as to how that puts the NYCERS portfolio on a monthly basis, at the end of January we were at $40.7 billion. Our estimate is we're back north of $42 billion, probably even a little more north as of after yesterday. So we're pushing the highs that we had at the about a year ago. And again, that's net of the $1.6 billion a year that we pay out of the fund. So again, I think we're back to being in good shape. If you look at page 36, you recall that we're going from the old asset allocation, new asset allocation. 36 is the page that takes you from the old to the new with our parking places in line. Because again, there's some things that take us time to change. As of January, we had 3.2% cash. As of now, we have no cash left. The cash has been all put back in the market, particularly relative to the new asset allocation. So the 3.2 has has been reinvested 1.2% in emerging markets, 1% into high yield, a little more than 0.5% in opportunistic fixed income, about 0.25% in hedge funds, and small amounts into real estate and private equity. In fact, we're having to fund some benefits, so we're rebalancing our equities downward, U.S. equities downward. So I would tell you that, again, as we move it through the rest of this fiscal year, we'll be trying to get ourselves back into the new asset allocation. And again, if I draw you to page 37, at the very bottom line, equities and fixed income, you can see we're a little overweighted equities, and that was really because the market started going up. But again, we're taking that down a little bit to get back in the range to fund benefits.
Larry, can I get you to commit to a new page
Yes.
by next meeting?
Yes, we have.
You can get me to commit to Martin.
No, I'm looking at you.
We hope to have this for you next month. We have an internal meeting that will help you finalize the report that we'll see next month. That will be, first of all, more readable with print and also color-coded, showing the parking places, where money's coming from, where it's going.
This is a commitment, yes?
Yeah.
All right.
It'd be nice if we could come up with a word that's better than parking places. Because parking places and securities law don't fit well together. So we'll have to think of something else.
Very expensive. You'll see in our report the word is interim.
Interim. How about another word? We'll come back to you, another commitment with another word besides no parking places.
Limbo will work, really.
Feels about right, but I don't think so. If you look on 38, at the far column on the left, you can look at the January numbers. Again, the stock market was up, the U.S. was up about 5%, international markets were up double digits, and the bond markets were also up. If you go to 40, you can see that those numbers translated into we made about 4% in the month of January, which gets us to down a little less than 1%. Then if you go back one page to 39, you'll see that February was up about as much as January in the U.S. stock market, up less so internationally and a little bumpier in the bond market, which is why I can project that hopefully in February we're probably up 1 to 2% for the fiscal year. The rest, again, is the asset manager by asset manager breakdown. And I will defer to Seema if you have any comments on any managers or any equities.
Yes.
Martin?
No,
John, Barry, Yvonne. Where's Yvonne? Real estate? So that's sort of January. January was good. February was good. March seems pretty good as long as we have yesterday, a couple more days. So I think, again, the worst, not the worst, a period of crisis is over for the short term. There are clouds out there. Greece is probably going to blow apart again. You got Portugal to worry about. You got Spain to worry about. But I think the euro has, for now, escaped the problem that it had in the fall. And the economy's on the mend. So I think the markets are headed for good times, hopefully, for the rest of the fiscal year, with ups and downs, but in general, up. So, unless there's any questions, that's the end of January. Okay.
So we had, the trustees have heard me ask Callan repeated many times for a drill down into the attribution and looking at our peer numbers on a more apples-to-apples basis. I know Callan is prepared to speak about it. Mark, do you think we'll take 20 minutes, 15 minutes? Then we should just go ahead and maybe do that if you have.
Sorry, just by way of introduction, Bud Leckia, who you've all met at prior meetings, Bud will be delivering this report, and I've got them here for distribution.
Good morning, everyone.
Morning, Bud.
As Mark mentioned, my name is Bud Flecky. It's nice to step up from the back row to the front row. So what you have in front of you is a memo which explains what we tried to do with this report. It outlines what the new benchmarks are and what exactly we're looking at really from a top-down level, looking at the total fund performance and then drilling down to the publicly traded asset class level. As you know, we had a new asset liability study performed last year, and there was a new asset allocation as a result. So we started the time clock as of September 30th, 2011, utilizing the new asset allocation, and therefore the total fund benchmark would be a reflection of what that new asset allocation looks like. However, as Larry just discussed, we realize that it's going to take time before we get the new asset allocation in place, especially in the areas of opportunistic fixed income and real estate and hedge funds. So we've created not only the long-term target benchmark, which is based off the asset allocation, the new asset allocation, but we have also created an interim total fund benchmark. And the interim benchmark is based off of, well, where were we when we started the time clock at September 30th, 2011? And for those three asset classes that we know we're going to take time to implement, we took a look at where we were at September 11th and assigned whatever percentage that was of the total fund to that benchmark. So for instance, for opportunistic fixed income, the benchmark is the Citigroup High Yield Index BB&B. Well, at September 30th, we only had 1.1% invested in opportunistic fixed income. And so to create the interim benchmark, we assigned that Citigroup High Yield BB&B 1.1% percentage, 1.1%. And then since we know we have 5% in the long-term target to opportunistic fixed income, we took the difference of the 1.1 from 5, and that was almost 4%. So we split it in half, the remaining percentage, from where we're drawing those assets from. And if you recall, Callan had created a memo back in, I guess it was December, which outlined where our recommendations of where the money would be drawn from to fund the new asset classes. As a result of that memo, the board approved those percentages, and so that's where we come up with the interim benchmark for the interim placemats or place settings for the three asset classes. So again, back to my example of opportunistic fixed income, we're drawing the money from Core Plus 5 and from the high yield index. So 1.95% from each is assigned to those two benchmarks, and that creates the total of 5%. So that's sort of a synopsis of how we came up with it. I'll walk you through this, and we'll get a better sense of what the benchmarks are. So if you start on page 2 of the presentation, you see a snapshot look of the actual asset allocation as of December 31 versus the target. And on this page 2, we're looking at the long-term target. So the long-term target is 33% domestic equities, 17 international. The structured fixed is at 20, high yield 4, opportunistic 5, tips 5, real estate 6, hedge funds 4, and private equity 7. The pie chart above that is where you were as of December 31. And you see that you are underweight in the three areas that we talked about, opportunistic fixed, real estate, and hedge funds. You're slightly overweight private equity, and you have an amount there assigned to in-house which is short-term investments and the employee-targeted investments.
I'm sorry, can I ask a question?
Sure.
On page 2.
Yes.
And this might be better directed to Mark, I'm not sure. So the bottom chart that says percent target.
Yes.
So the ones that are 0 are investments that we're going to get out of. Is that correct?
Well, for instance, progress fixed is going to remain potentially.
Yeah, so let me, can I put my 2 cents in here? So
I'm good. Yeah.
the way we show this, progress fixed because it's effectively core fixed income, when we show it in our charts, it goes into the core plus 5 total because it effectively mimics that allocation.
Okay.
The same thing with the ETIs. Actually, ETIs has a separate line on there that, as you know, has draws from all asset classes, 2% of the overall retirement system, but not any one specific asset class.
Is that what we're calling the in-house?
That's what the in-house is.
Okay.
And
We're getting out of convertibles?
and convertibles. What happened was Callan did not model separately, and I think it simply came out of the high yield model.
Yeah, these aren't meant to imply anything at all about where you're headed out. It's simply the
That's
asset
being rolled
allocation.
over.
Yeah, okay, that's correct. Opportunistic is, convertibles is part of something, just as progress fixed is part of something else. Thank you.
And one thing I did not mention earlier is that Callan does not calculate the returns on your portfolio either at the total fund level, the asset class level, or the manager level. We get a direct feed from your custodian. And when we get that feed, the feed includes a breakout for these areas that we don't necessarily break out, but since they come that way, we're showing you what the effect is. The top chart just shows you how your allocation compares to other funds in Callan's public fund database. So, for instance, if you look at the real estate allocation, the fund is currently at 3.67%. The target is 6%. The median in our public fund database has a 8.45% allocation to real estate. So you're slightly below at your target level.
So in real estate, that ranking, is that on the target or the action?
It's on the actual.
Well, it's actually there on both.
Both, yeah.
Larry.
The maroon circle is the actual. The triangle in blue is the target.
I got you. Okay.
And
And these are in comparison to our peers or to the whole?
This comparison is for all public funds. We'll see later a more direct comparison of size to plans of your size.
And this is just portfolio weighting, not performance.
Right. Correct. Just look at portfolio rating. Okay. So page 3 takes a look at your actual allocation versus the interim target that I talked about. So you're not all the way at your new long-term target, you're at an interim target. The interim targets for broad domestic equity, global ex-US equity, so international equity, fixed income, tips, high yield, and private equity, it's the same benchmark because you're basically at or near that long-term target. It's the 3 asset classes that you're below target, real estate, hedge funds, and opportunistic, that affects the interim target. And again, we took a snapshot look at where you were at September 30th, and then the difference of where you were to where you want to be is held by the asset classes that it's pulling from. So in real estate, it's pulling from U.S. equities and core plus 5. So that's why the blended benchmark for real estate is made up of the long-term benchmark for real estate plus a blend of U.S. equities and core fixed income. To the right on page 3, I basically summed up some common benchmarks. So, for instance, like real estate has a blended benchmark of the real estate index plus the Russell 3000 plus the core plus 5. Well, what I did when to the right on bottom of page 3 is to say, what if I added up all the indices that would show you that you're at a 35.4% Russell 3000 index for the interim benchmark, 16.9 non-U.S., 24.7 for the core plus 5, again, because we're pulling from those asset classes over the next number of months. There is a typo in the pie chart at the top of page 3 on the right. Private equity really has 9% currently. That's a typo. Okay, so now you have what the long-term target is, what we've calculated to be an interim target, effective September 30th. So now we're going to take a look at the attribution analysis on page 4. And this is versus the long-term target.
Before you do that, can I ask you a question? Because I'm not quite sure when to ask you this question, but I probably should ask it to you in your original letter. When you look at private equity, the benchmark you're using is the Russell 3000 plus 5%.
Right.
And that's a long-term target. I would offer to you that, to my mind, it doesn't make sense to do that relative to private equity on a short-term basis. As we all know, it lags. So when the stock market goes up, it's always going to be behind. When the stock market goes down, it's always going to look better.
Right.
Have you ever looked at the reality of our statements are that we're always a month behind, a quarter behind. And for those trustees who don't really focus on this, so if we have a June 30 balance sheet, everything is as of June 30 except for private equity, which has your March 31st statements in it, because the statements come out, they get prepared, you get estimate the value of them, they get put in the mail, and then we kind of have this legislative thing. So your June 30 numbers have March 31 valuations, plus if the private equity firms own public securities, it actually has the public securities market March 31. So I would ask you if you could do some analysis as to what would happen if you lagged our private equity performance in the benchmark to more directly line up with the actual numbers we're looking at. And that might take some of your lag out of it.
Right.
And also make it similar to the numbers that we're actually looking at.
Right. I was going to address the problem with the attribution for this particular quarter as it relates to that. But I didn't want to introduce anything new, being this is the first time that I'm showing it, given that your long-term target is Russell 2000 plus 5.
Right.
But what I would like to do is take your advice, and at the next meeting, when we show it again, maybe show both ways, have a long-term target, and then use show the lag, go back to the previous quarter for private equity.
So could I suggest a different approach? I think Larry's point is exactly right. And I actually would go further and say that for under 3 to 5 years, Russell 3000 plus 500 is meaningless, because there's just no way an asset class can be expected to outperform a risk premium, an absolute risk premium benchmark like that over short time periods. So just like we do for hedge funds, what's actually more relevant might be the top quartile in the universe, and then there are no lags because everybody has the same issue. But that we move to thinking about, and there's just no way you'll be able to do this for us till we get to 3 and 5 years because you don't have the attributions. But that we start thinking about our long-term performance, and you start showing us rolling 3-year performance versus things like 3,000 plus 500, which are risk premium benchmarks, which we should be earning. But on a quarterly or an annual report, those are just not the bogey. I mean, it comes back to the right policy benchmark versus interim short-term policy benchmark versus the long-term benchmark. Does that make sense, Larry?
That's totally right.
Yeah, I think there's maybe 3 points to keep in mind, and I know Button's going to be bringing this up. First is that remember, we're just starting this thing. It's 1 quarter that we've got, and not only is this 1 quarter, it's a quarter that went from a huge down quarter into a huge up quarter. And in areas like private equity, the attribution that Bud will talk about and performance really shows exactly the problem with that, so that's not unusual. The second thing is, to Raji's point, when in fact these things go, we end up with longer periods, 3, 4, 5 years. In fact, much of these quarter-to-quarter issues shake out. You end up with something like this. But here, this is all you've got. So that's the third thing. The third is that there really are steps that we can take to isolate this, as we've done with other clients. Some of which you talked about. Some of which is essentially to make the target return the actual return. So you essentially neutralize in an area where it's a problem. So there are steps that we can take for that. As Bud indicated, at this first step, we wanted to see exactly what we do and get a sense for the work that's involved.
Okay, so just to explain how this chart works on page 4, the target return shows what you would have returned for the quarter ending December 31 had you been 100% invested in index funds at the target weight. And the blend of those index funds are defined at the bottom of the page. They're what I described before for the long-term target. So that return would have been a 6.64% return. Your actual return was 5.49% return. And as was pointed out, it's important to recognize that the private equity is on a 1-quarter lag, and we're comparing it against the current quarter target return. So you see the private equity actual return of negative 171 versus a target return of 1337. That is really apples to oranges, and it creates the big negative manager effect of negative 132. And that's what we will address going forward to alleviate that problem. So the manager effect is all the differences in the performance of the actual manager versus their benchmark. The style allocation or asset allocation effect is the deviations from your long-term target. By being in an asset class that is not consistent with your long-term target, that was actually a positive 24 basis points for this particular quarter. And that's against the long-term target. The next page does the same analysis on that interim target that we came up with. And so the interim target return, had you been 100% invested, actually performed a little bit better, 6.83%. Your actual return is the same at 549. The manager effect was slightly higher, or slightly more negative, 147. Again, reflecting private equity for the most part, as well as opportunistic fixed income.
What is the opportunistic fixed income story, Martin?
The issue is the wind down of several funds that we can talk about in the executive session, and how the calculation is shown, the time weighted versus the IRR calculation. And as I think we described in the past, actually we described last month, we're working on a report that will show the boards, each of the managers with each of the IRRs that we've now been reconciled to Bank of New York, to reconcile the difference between the IRR calculation and the time-weighted rates of returns. The same issue that we've had with private equity real estate.
But with high yield up 5.5 for the month, or 6%, our opportunistic down 9.5. You can't explain all of that with IRR time-weighted difference.
Yeah, you can, because when certain large funds are in...
All right, do you want to do this in executive session?
Yeah.
Okay.
It's a problem we have, cut to the chase, it's a problem we have with the bony data. And if you're taking the feed off the bony data, it's not the right, we don't get the right.
For the private market.
For the optimistic fixed income funds.
And private equity.
Right. We'll talk about that in executive if you like. That's the problem. We've been trying to get it fixed and we've been unable to. So if you're getting the feed from them, it's the same bad data.
Page 6 shows the peer comparisons versus other public funds. And this one is compared against public funds with 10 billion plus in assets. So this is cumulative performance at the top of the page for the 1, 2, 3, 4, and 5 years. And you see that other than this last year where you were basically at median, all the other periods are above median. And then at the bottom of the page is the same database, but on a calendar year basis. 2010, 2009 were strong. 2008, though negative, was still in the top half. And then you see years like 07, 6, 5, 4, and 3, where, well, through back to 04, where you're below median, but you were still ahead of your targets. So I think you got to look at both when you're examining your performance. Page 7 is a similar analysis, but it is adjusted for asset allocation. So what we do here is we say, well, what if everybody had the same asset allocation as NYCERS in the database? And so now we're not going to say that everybody has the same breakdown of fixed income or the same breakdown of equity, but for your percentage in equity, fixed income, real estate, or whatever asset class you've had historically, we're going to say, well, the other funds within the database are going to have the same asset allocation, and we're going to compare the performance for them versus your performance. And those are shown here on page 7.
Is 7 adjusted for the inner allocation or the long-term allocation?
Well, because we're looking historically, we're looking at what your actual historic
Actual.
Yeah.
I'm sorry, so the blue numbers indicate, for example, on page 6, the blue number 31 in the last year, what does that indicate?
That's your target return. The target the target portfolio return. Yeah, the benchmark, the blended benchmark return for your total fund.
So Al, what that's telling you is that in 2011, your target return, if you had been invested exactly according to asset allocation and in index funds, you would have achieved a return of 2.04%. That would have been in the 31st percentile, top third of your peers. For 11, you actually lagged that target a little bit, but still ranked right around median.
Oh, I see. So the 31 is
That's the ranking. That's the percentile ranking.
So, but page 7 is the page I have been waiting for, right? And I would love to have had far more detail if we can get that next time. So the annual numbers, the benchmark versus the actual, because this actually is the true closest we're going to come to an apples to apples comparison of sort of where we are and the value added, right?
Yes. And yes, I can provide you with calendar years and further back if you want, and the benchmark, where NYCERS was from an asset allocation point of view over time.
And also, if there is a sense we can get of the peers that are in this benchmark, a listing with their asset size, because I think honing this in terms of how we think about how we're doing is very important to this exercise. Ray and then Larry.
Could you actually tell us what this chart means?
This is a very important chart.
Okay, I tried to, but I'll try again. So we all know that asset allocation can drive differences in performance, right? One fund could have 80% equity, another fund could have only 40% equity, and that's going to be a big driver of performance, correct? So when we compare your fund against other funds in the previous page 6, everybody has a different asset allocation than you do. So on page 7, we tried to make it more of a apples-to-apples comparison by saying, well, what if everybody in the database had the same asset allocation as NYCERS? And then we compare their performance. So they may have only had 20% in fixed income, but your allocation is 30%. I'm just drawing numbers. So we make their asset allocation equal to yours at 30, and we apply their performance on 30% rather than just on the 20%.
So Ray, what it's really meant to get at,
And it shows
how their managers compare against your managers.
which is,
you've done a good job.
well, what does the 40 mean?
What that means is that remember what Bud just talked about is we've now given everybody your asset allocation.
What does the 40 mean? Can you just explain?
40%
Percentile ranking, above median.
So 60% of our peers do worse than we do.
Last year.
40% do better. We are at the 40th percentile.
Okay. And why do the boxes float?
Because year to year, there's different ranges of performance.
So let's look at last year. The best performer had a 3% return. The worst performer had something like a minus 1.5% return. And our return, which was positive 1.1, put us in the, if you simply arrayed everybody from top to bottom, we would have been 40th from the top.
So those are the quartiles.
Quartiles.
All right.
These are 1, 2, 3, 4, so they're quartiles, yes.
Well, it's normalized it all to assume that everyone had the same asset.
Right.
So it's just the manager.
So think of it this way, as a board, based on our staff and our consultant's recommendation, we decide on the asset allocation.
Right.
We own that decision.
Right.
What we then turn to BAM to do is to manage and outperform the policy benchmark.
Right.
So year after year, quarter after quarter...
That's not quite right.
Well, let me finish.
Yeah.
Year after year, quarter after quarter, what we're telling BAM is this is what the kind of risk we want to take in this portfolio. That's what the policy benchmarks are there to say. And what is return? Nobody can predict return. It's simply the payment for risk. So a big part of our return is simply how much risk we're willing to take, or beta. And in fact, some of the returns, some of the stuff we looked at in the asset allocation analysis last year showed over 90% of our returns come from our policy benchmark, come from the beta or the benchmarks that we pick.
What I was going to say is not quite right, is the way NYCERS in the city is set up, the boards are responsible as well as BAM for manager selection. Right? So from a governance standpoint, the board makes the manager selection.
Fair enough.
Right?
So
So the board ranking...
As much as
BAM.
yes.
There are other places where it's delegated to the investment staff, and they're
Fair enough.
responsible. Right? That's not how this is set up.
So-
Larry, the board makes its decisions based on recommendations made by BAM and our other consultants. And I would venture to say that very rarely does the board do something other than what is recommended.
I can't speak to how it was in the past. I'm just saying the process here is that the investment committee is the board.
Right.
So we're all in the same boat for the investment
And the
decision.
board makes its decisions 97 times out of 100 based on what we're told by BAM and our consultants.
So the way I would say that is accountability for beta truly resides with the board. Accountability for alpha, to Larry's point, doesn't 100% reside with BAM, but BAM owns the majority of it. I would agree with that.
Fair enough.
So getting rid of the Greek letters. Do I understand taking the last year of this chart? Do I understand then that if you standardize the asset allocation, we did better than 60%, but when you take into account the actual selection of the particular investments or the money managers that we have, 40% did better than us with the same standardized asset allocation. Is that what that means?
You just flipped your number. Yes. So we 60% did worse than us, 40% did better than us. Yeah. And in a year like last year, the other thing to look at versus 3 years, you go to 3 years and you see that the top managers start to gap, right? Or the top funds start to gap a lot more. So the dispersion wasn't very great last year. That the size of the box is pretty small, right? So you start to look for patterns like that over time too. And I think what you will find is that the top quartile tends to gap away. So there's a bigger difference between middle and top quartile than there is between the middle and the bottom sometimes. So you're looking for a lot of different trends over time.
These are calendar years, right?
These are
Through
cumulative
year end.
on page 7.
But calendar for fiscal?
No, this is based on December 31st data.
Yeah, ending December.
So bear in mind, to Ranji's point, you're talking about 2011, 10, and 9.
Very volatile.
Right, very volatile years, particularly 9, because remember, March is when all hell broke loose and hit the bottom. So you have a very bad starting point, I would tell you, in your data set. Probably looking back past that might be interesting, and possibly skipping a year or two. It's just, this is a strange set of data to actually look at. It's the most volatile period in the last X number of years, and it put the most strain on your managers, obviously.
Well, there's another phenomenon this captures too, which actually is also to BAM's credit, which is how many managers have you guys fired? How much turnover have we had? More than normal, right?
I think we turned over a third of the active managers.
So when you have that, you have a bid-offer issue going on. You have transaction costs. So this is after that. This takes that into account because it's in the performance.
And one other clarification on page 7, when you strip out or you equate the asset allocation across funds, we are not equating the structure. So although this is really telling you a story about manager performance, it's also telling you a story about structure within each asset class.
Correct. So we may have longer bonds than aggregate or shorter. Yeah.
Okay, so I think I understand what page 7 means, but now it's kind of confused me as to clouding again what page 6 means. So page 6 is, if I understand it correctly, the blue line is how our asset allocation would have performed. How NYCERS asset allocation would have performed. And the red line is what we actually did.
The red is what you actually did, that's correct. Yep.
So you would say that the difference between those two was the management effect.
During that particular year, that's correct, Al, that's correct. And like any of these, the more you build the record, the more reliable, the more you can rely on the data itself. So just as in measuring a manager, 1 year performance is less reliable than 3, which is less reliable than 5. I think the important thing on page 7, for clients that we have been delivering these for years to, very often if Bud and I are delivering this, we'll sort of spend a half a minute on a page and say, here's the message. The message of page 7 to me is that you all have done your job of implementing at the fund level, whether it's the board or BAM, independent of that, but implementing your plan over these longer time periods has been positive, very strongly positive to what your peers have done. That's something that's been done well. Top quartile ranking for 5 years, top third for 4, etc. The implementation, putting together the structure and the managers that you've hired has been strong over that period of time. And this is very often is things we spend a lot of time on with those clients.
On page 6, the policy target, is that the new policy target?
It reflects what it was over time. So
last year would have been as of when we did the asset allocation?
It blends.
September.
We changed it September 30th.
I changed it September 30th to the due.
So it blends for that year?
Yeah. Ranji, in the interest of time, I broke it down the next few pages by asset class. Do you want to go through them, or?
I think it's up to my.
I think the interest. No, we were saying in the interest of time. This is. This first part was the important part.
Yeah.
We wanted to spend time on.
I think some salient points that should be made. Unless there's something very dramatic or whatever that you'd like to say on the following page, rather than going through the discrepancies.
No, other than just point out some differences in historical performance. The last few years in domestic equity has underperformed, but the longer-term performance has been better. There's just some nuances across time periods that I could comment on. And as it relates to fixed income, we created an interim fixed income benchmark as well because we are still funding up opportunistic. So there's two benchmarks for fixed income.
So for equity, looking at page 8, we outperformed our asset allocation, is that correct?
For this last quarter, you
Yeah.
outperformed, yes.
Yay!
But one of the things you
In the last
notice,
2 years, we outperformed our allocation.
Slightly underperformed.
one of the things you notice is that really over time, the comparison of your total fund to your benchmark is essentially right on target with the benchmark. And that's not unexpected given how much the portfolio is passed.
We will continue to feel right on top of it.
Bob's not here, so, but I know Bob would have a comment on that.
So I hope this is just the beginning of a quarterly conversation and that you bring in information ratio, Sharpe ratio, because we really need, as a board, to start to understand what risks are we taking and where are we getting paid to take those risks. And so I think we will allow more time for this next time. We have two sets of guests waiting for us. I'm feeling a little under pressure here, but if there are any questions, we should stay with it. But I do look forward to developing this report further. And if anybody has comments or thoughts, and Larry, Carey, you sit on a whole bunch of other boards. If you have, there are things that you see that we should be talking about on other boards, happy to.
Well, you generally far more sophisticated.
That's good to hear.
No, I just want to say, I find this extremely interesting and helpful, and actually would like to spend
More time.
more.
Good, me too.
Thank you.
So we have thank you, Bud. This is very, very good start for all of us. We have two sets of guests, and I'm going to change the order a little bit if everybody's okay with it. We have folks from the CFA Institute here to talk about the Asset Manager Code of Conduct, and we have Wayne Hawley here from the COIB. Having spoken to both of them, Wayne has a hard stop, and so can we resequence a little bit if you all are okay, and do we go into executive session for that?
Executive session, and then we'll come back out of executive session back in.
So a
Get
motion,
these guys shut down, go wait in the other room, and then come back.
Can you give us a minute, please?
yes, please. Motion to go into executive session, do you have a second? All any opposed? We will wait for the camera. I want to thank Chuck Champion for coming in today. Chuck may be known to some of you, or certainly known to almost everybody who's been in the business. Chuck is now the Director of Special Projects at the CFA Institute, having had a very illustrious career, much of it at GM Investment Management, among other places. Chuck had been joined by Kurt Schacht, who unfortunately, given our significant delay, thank you for waiting almost 2 hours, Chuck, had to leave to go to another meeting. So without much ado, I'm going to turn this over to Chuck, except to say the following. Chuck found me about a year ago, and since then I have been serving as a member on something called the Asset Manager Code of Conduct Advisory Committee at the CFA Institute. And Ron Payton from Callan has also joined the committee. So with that disclosure, I'm just going to turn it over to you.
Thank you, Ranji, and thank you all for giving me the opportunity to talk to you for a few minutes about CFA Institute as well as our Asset Manager Code of Professional Conduct. First off, on the Institute, we'll just walk briefly through these charts. CFA Institute is a global network of member societies and individual members that currently number over 105,000. Almost 100,000 of which hold the Chartered Financial Analyst designation. And we have members in 139 countries throughout the world. We run the CFA program, and the latest candidate count for the current year is actually a few thousand more than the 210,000 that registered in 2011. So we're looking forward to continued growth of our membership and spread throughout the world. The network of societies now numbers 135 in 58 different countries. As you can see from the map, the vast bulk of the societies still remain within North America, the U.S., and Canada. Our mission is to lead the investment profession globally by setting the highest standards of ethics, education, and professional excellence. And this chart on page 3 sort of lists the major programs that are under those 3 E's of our mission. The Asset Manager Code of Professional Conduct that I'm talking about sort of falls under both the ethics side and the excellence side. And there's always a little bit of education in everything that we do. Well, why an Asset Manager Code of Professional Conduct? Well, as all of us that have lived through the financial crisis, we have seen that the recent market collapse was devastating to the faith and confidence of the marketplace in the investment industry. If you look at the graph on the right in terms of this is a 2011 trust index that's gathered by an independent survey firm, shows that the financial services industries that are surveyed are right there at the bottom, at around 50% of people saying that you can trust them. We found over the long term that functioning capital markets depend on trust, from the aspect of talking to your broker and saying, I will buy or I will sell, all the way up to the level of communicating with investment boards such as this. You have to have trust in the people that work for you. And good ethics is a fundamental piece of that market integrity and trust. So, we're expecting, and part of this decline of trust is that clients are demanding not just performance, but also ethical conduct from their managers. So in this environment, we could set out that what does the industry need to do to restore that trust? Well, there's a whole, basically to adhere to fundamental ethical principles, the first and foremost of which I think is that client interests always come first. I mean, if you obey that one, pretty much the other ones fall in place, because they all stem from putting the interest of the people that you serve before your own. How do firms do that? Well, it's going to be to develop an ethical culture, setting first and foremost to set the tone at the top. I mean, if people are run by a firm is run by a Bernie Madoff, it's very difficult to have the whole firm become ethical. On the other hand, there are many firms out there that have a committed ethical culture, and they have been able to weather the storm much better. But how do you know whether that firm is ethical? I think you need to sort of establish a core and recognized ethical global standard that will generate that people can say, well, this distinguishes me from my competitors by being able to claim compliance. And we think that the Asset Manager Code of Professional Conduct would do that. It was started back in 2005. This was one of Kurt's initial projects and initiatives when he joined CFA Institute. We basically took, as is shown on page 6, we took the basic provisions of the individual code that CFA charter holders and other members of CFA Institute have to abide by and sign off on annually. These 6 sort of categories embody those principles. loyalty to clients all the way down to adequate disclosures. And we changed them a bit to have it apply not to an individual but to an investment firm. The code itself, which is in the booklet, is only about 2.5 pages long, so we're not trying to write the tax code. And it currently has an additional maybe 3 pages of guidance, which drills down a little bit. But the idea here was to set a very broad, principles-based type of code that could fit into the operating and compliance activities of an investment firm, and frankly not to have them necessarily rewrite their own code, but to be able to see that their own code met or exceeded the provisions of the asset manager code, and thereby be able to claim compliance. So it is unlike one of our more promulgated standards of global investment performance standards, where you sort of have to adopt GIPS in all of its provisions, which are somewhat detailed in the performance presentation area. This code you can adopt by having your own code and not this code, but as long as its provisions meet the requirements of the asset manager code, you can still claim compliance. On page 7, as Ranji referenced, we set up a year ago an advisory committee to help CFA Institute carry forward on awareness, adoption, and implementation of the code. And the main operating priorities of it were and continue to be to try to establish liaisons through the committee's membership, which Ranji has been very helpful in doing, in part in getting meetings with service providers such as Callan, that advises your board, as well as a meeting with the board and the staff itself. And we're also going to ongoing work of making sure that the code remains relevant in a changing world to what is needed to continue to build investment trust in the investment profession. Chart 8 basically sets out the committee. The message here is just basically that it is global and it's diversified, not only geographically but also functionally. And Ranji's membership, Ranji is one of 3 pension plan sponsors that are on it, and Ron Payton of Callan represents the consultant input into the advisory committee. And then finally, while we're not trying to sell you anything, I've always been told that you should, in some ways, ask for the order when you get the ability to present. So why should the New York City Employee Retirement System Board adopt this code or encourage the staff to adopt it? Especially in light of the fact that we learned from staff that your due diligence process in hiring managers culminates in them having to sign a number of documents, the combination of which basically has them agree to all or more of the provisions that are contained in the asset manager code. We think if you adopt the code itself, this would provide additional due diligence protection for the funds. And it would also put you in a position of being a first mover for improving trust in the investment profession. There's the potential, if adopted by the other New York City plan boards, to have a consistent approach across all 5. And we're hoping that by having organizations like New York City, encourage or require compliance, when that happens, then the investment firms, by claiming compliance, will subject themselves to the standard-setting activity and the SEC checks and balances on that claim of compliance. that we've experienced as we've promulgated global investment performance standards in the U.S. and Canada and throughout the world. That the SEC, when they see a claim of compliance, will serve as our enforcement of that by saying, well, okay, you claim compliance of this under the anti-fraud provisions, show us how you're complying. So that is a very good carrot or stick, as the case may be, to breeding adoption. Pure and simple, we'd like the New York City Employee Retirement System to send an important message along with us to the industry and its own beneficiaries regarding a way forward to improving trust in the investment profession. And I'll be happy to answer any questions that you might have, but that's my message. Thank you.
I'm a little confused as to where this sits in the realm of things that we do. I've got Catherine here who sort of watches over a bunch of this stuff for us. I think we do 95, 99, or 110% of this already.
Yeah.
Is there a list of people that do this?
Yes, there is. We have on the CFA Institute website, there is a list of the approximately 600 plus investment firms that currently claim compliance with the asset manager code.
So do all the whole pension funds do it, or are we missing it, or are we reading it?
Well, the list is of investment firms, so there aren't any other pension funds listed on that list.
So it's the
But there are. I would hazard to guess. I know I couldn't get through your website a list of your current investment managers. I know that it's publicly available. I just couldn't quite find it. I did find
our website. You'll see it.
I was able to go through, if I can mention them in this context, I was able to get to the Teachers Retirement System website for their 403B investment offerings, and they had a list of the performance and their investment managers, and of their, I don't know, must be 150 investment firms that were on that list. There were 22 of them that claimed compliance with the asset manager code.
So Larry, if I may clarify, the code is for people we hire to manage our money, right? It's not for us.
Right.
And so we have, and I'd love to have Catherine or Thad talk about this a little bit about, because we do kind of cover the same ground in a variety of documents. What we're trying to do at the CFA Institute is to get the 22 firms to be 150 or 100% of all the firms that we might do business with should comply with the code of conduct. That's the goal, right? Now, they may get there in a different way, and we'll hear about it in a moment, but this is to get more and more asset managers who seek our business to comply with it.
I'm sorry, Ranji, who are the 22 that you referred to?
Chuck was just saying Chuck went to the TRS, the variable funds.
Managers that have signed this.
600.
Larry's question was whether any pension funds who are technically asset managers sign up to this.
Oh, I thought you were asking whether pension funds, how many pension funds are requiring this of all their managers?
I was asking, to Al's question, is this a buy-side thing or a sell-side thing, to put it really simply?
Are we the buy side? Are pension funds the buy side?
We're the buy-side.
In that context, it's the sell side, but it's for the
Yes, exactly.
The asset manager, not the brokers, which I.
It's for our vendors.
The asset managers,
Not
your sell side.
But we are in the position to get them to adopt it.
To be ambassadors, and to a certain extent, I may have stated this poorly, but I think we learned from our meeting with the staff that you basically have, through your own documentation and paperwork, when you sign on an investment manager, I would say that all of your investment managers, by signing that work, are probably already in compliance, because the provisions that you require are equal to, within a 5% either side of it framework of what's required in the code.
Catherine, do you want to comment to that?
Why don't you give us a quick overview of what we have?
I'll stand up so you can see me.
Why don't you sit down? That's come to the table.
For our managers, through a combination of our investment manager agreement, our guidelines, our ethics and compliance policy, which everybody has to sign annually, the fact that we require SEC registration and our fiduciary standards, and also our quarterly compliance questionnaire, all of the things are more or less covered. Not exactly in the same language, but in the concept of each of the points. So we are asking for that in various ways, and getting a lot of paperwork from our managers in order to address those issues.
And that's the same for all the funds, right? Just for the record, just like
Yes. There's consistency of cost.
No, go ahead, please.
Well, I mean, to Larry's question, as I'm reading this, everything I read in here sounds like things the fund should be. A code of conduct for this.
Great. So we have our first draft of what would be our own code of conduct, maybe. Fair enough.
Right. I mean, this looks great. Well, that's for this one.
I'm not prepared to say that.
Nobody is. He's just, no one's adopting this today, not for sure.
That way you're holding now is not...
But Al's point is this has a lot of things that we would care about in it, and it's all in one place, right? I mean, the one concern I have about what Catherine said is the same in other places is there one place that a manager can go to and say, here's what we need to do business with New York City? And is there value to that? We can debate it as a board. Larry?
Yeah, well, I guess my first question is, what's the reluctance in your experience to get asset managers to sign on to this code? I mean, you've been around a while. Some people, 600 have. I mean, obviously, some large section of the universe or small section of the universe has not signed it. What's the reluctance in your experience?
There are two arguments that consistently come up. One is one where they've looked at the code and its provisions and they say, well, before we ask, this is generally from fund-to-funds managers who would also go out and hire investment managers to do their bidding. And they say that, well, we can't do it unless we can actually commit ourselves to meeting the standards. And in some cases, large investment management firms get lost in some of the detail. For example, there's a requirement in the guidance on the code that when you're dealing with soft dollar issues, that you be able to tell the individual client how many of their commissions were issued by soft dollars. Well, if you're a small investment firm, maybe having 24 clients, and you may even be large in assets, that's not a particularly challenging thing to do, to be able to tell one of the clients so much of your commission dollars was used to purchase research services for everybody. If you are a private wealth manager having thousands of accounts, you may know in aggregate what you did, but to get it down to the individual client level would be very difficult and expensive. So they say, we're not going to put on that expense until we see that we have to. And that leads to the second category of people that basically say, this is another code that we have to adopt. We may be subject to, more regulatory review, like I referenced here, that the SEC is going to come and you claim compliance with the asset manager code. Show us how you do. And they say, until the marketplace gets to the point of saying we demand it, we're going to hold off on claiming compliance. And that's the area that we're trying to get at by focusing in on having folks such as the New York City retirement system or the Bureau of Investment or other individual plan sponsors or fund-to-fund managers or consultants such as Callan buy into this and start asking about are you in compliance with the asset manager code?
I have to say, since we have a huge list of requirements, I personally would have to have some idea whether this is just surplusage or whether it actually changes something. Because if we're going to make this a requirement to do business with us, I want to know that that fight is worth something. Because if we have substantially all of it, or we have all of it, or what we have, I'd like to know, what I'm fighting over. Because, I may want, you understand what I'm saying. It has to mean something. Otherwise, I don't believe in window dressing. If all it is window dressing and there's a manager that doesn't want to sign it, but we want to hire that manager, that's an issue for me in terms of being able to make the best investment possible. So I would really, if we're going to walk down the road, I'd like to have, and I'm not going to do it, I'd like to have some staff person really, give me a real comparison between what we have and what's in place and what this would require, and we should be able to think about it.
So Larry, that was my reaction as well, which is, in a way, what this forces us to do, and I thank BAM for going back to do it, but I'm hoping that it's a very simple mapping of what are the elements that are contained in here, and where are we now. And I'm a little concerned that as a manager, I will have a code of conduct policy for New York City in 5 different places. There are different people inside a firm that look at the guidelines and a different person that looks at the contract. I want to know that the firm has signed off on this and that everybody who is managing money for me on my account is aware of what the code of conduct is and has signed off. So I would like us to think about it as a board, but I think there are 2 levels at which we pick managers. One is when they get to BAM. With our new procurement process, a lot of this now, we've transferred the onus on some of this to Callan. Because you guys, Bud and Mark, I'm turning to you now, are looking at managers and screening them well before they will get to BAM for the new process. So it'd be very helpful if you guys can give us your answers to some of Larry's questions in particular, but broadly to the CFA code.
From our standpoint, Chuck had mentioned that Ron Payton, our chair, he actually served on the committee that helped develop and establish GIPS as the performance standard also, and to some extent, I think we think about this a little bit the same. Ron will be serving on this, he's been asked to join this committee and has agreed to. And I think there's 2 aspects to this. One of them is the aspect of simply a code of professional conduct. And that's the aspect that I think we're going to have the most interest in, helping to develop and help lead the industry toward investment managers making the decision to adopt that or not. One of the ways I think we'll be doing that is through simply adding a check-off box to our questionnaire that asks managers whether, in fact, they have elected to comply with this. That's not meant, just as it is in GIPS, to be a disqualifying item for any particular client. Many clients adopt their own policies for, and as we've heard here, in this situation, New York City has adopted their own, and many of those make up or are a big part of this. However, the industry as a whole, many clients don't have any standards of this of any kind. And something like this becomes very important for managers to be able to demonstrate, hey, we're meeting common industry standards and sign this off. So I think the way Callan views our role in this is that we're supportive of making sure that there's a code of professional conduct that managers can adopt. As it relates specifically to a client like New York City, I think the decision is that enough? Is that what you do, or do you use your own standards? And I think that's for later negotiation. But I do think that this is an important issue that the industry can stand behind.
Mark, does this somehow burden smaller businesses?
Well, and actually, I think we asked in the conference call that we had last week that Ron was on. I think we actually asked that question, and I think the adoption standards, Chuck, you indicated, so far is actually higher by smaller firms than it is by larger firms. To some extent, smaller firms view this as, hey, this is something I can easily do, check off the box, and be considered, and it might be harder for larger firms. But following GIPS also, I think the adoption standard increased as time went on. As it became more of viewed as an industry standard, there was a lot more willingness to adopt it, and in some cases, I mean, I remember one of the searches we did earlier this year for NYCERS, one of the managers had not adopted GIPS standards and did as a result of the search work that you would go through. Whether that will happen down the road with this is another question, but I do think as it becomes more and more accepted, it becomes more and more the managers view to say, this thing is not limiting me, it is creating an opportunity.
Larry, and then back.
Is Goldman Sachs a signatory?
No, not yet.
Not ever. I don't know. Just gather the data.
Well, that's a question in mind as well, but say now an asset manager signs on, how are you going to monitor whether they adhere to the codes, having signed on to the codes, or is it the first time you learn about it, you read about it in the newspaper?
Well, it is a voluntary standard, just as GIPS is a voluntary standard. CFA Institute does not have any enforcement capability or that we have it now or we intend to have in the future. We feel that what will happen if this tends to be a marketplace demanded characteristic of investment firms in order to be considered by the buy side is that they will be operating, at least in the United States, under the rules of the SEC or at least FINRA. And if those organizations go in and do examinations and say, as with GIPS, well, you claim compliance with the Asset Manager Code, show us how. And it's fairly clear how, I mean, this is a principle-based thing. Most advisors under the 40s Act have to have a code of conduct or code of ethics. Most of those probably already comply with this, just as your provisions do. But if they don't, the SEC would, institute whatever legal provisions they have saying, well, you've claimed compliance with something, that's fraud. So we're hoping that just as with GIPS, it will be the threat of being seen as being claiming compliance with something that you aren't in fact compliant with that will cause the compliance to take place.
So are we then relying on the SEC to monitor them?
Well, you're relying first and foremost on the integrity of the investment firm to not claim compliance. If you believe that there is no integrity at all in the profession.
Well, not in the entire universe, but we've been seeing that there is a lack of such over the years, and we suffered terribly as a result of that.
But that's exactly what led to the creation of the code. Right? That is exactly. This is all related.
I just would like to see, sign on and go about your business like you've always done, and hope that no one catches up.
Pat, would it be useful if we came to the board at the next meeting with inventory of all the stuff that we do? Because I think what you'll find...
I think to the governance committee, but yes.
I think what you'll find is Dan does, again, I don't want to put a number in it, but something north of 95% of this in different pieces of paper and relies on the SEC and forms they fill out and all that. So I think it might be useful just to see all the stuff that we do, and we do it quarterly. Now, that said, if they lie on their forms, we don't know that they're lying.
I know it's like the Ten Commandments. People do what's going on, but they don't necessarily adhere to it.
Jimmy and then Larry.
Sorry if I missed this. Can you clarify the difference or if any, between gifts and your code of ethics?
So, the Global Investment Performance Standards is very focused on the way an investment manager presents their historical performance record to potential and even existing clients. So it has a lot of rules and requirements that go to calculation and inclusion of accounts and everything like this. So it's more rules-based, and it's very focused just on performance. Okay, the Asset Manager Code has an element of performance presentation in it, but it is to the more general aspect of the way one conducts themselves professionally, putting the client first, having a reasonable basis for making your investment decisions and having them supportable, having how you do your trading, your allocation of buys and sells to investment, the investment accounts of your clients, the disclosures you have to make to clients and to the public on what you do. So your risk management practices and procedures. So it's much more all-encompassing. It's something that most investment firms that are registered with the SEC will have, to using Larry's number, 95 to 105% of. But in many ways throughout the global world, when we started this in 2005, you were looking at a large contingent of alternative investment managers and hedge funds that were not registered with the SEC. And this could form a code of conduct that they could adopt that would be able to have them display that they were in compliance with the broad principles. And globally, we don't have, outside of the U.S., Canada, and the U.K., there's not a lot of, regulatory authorities that require this sort of thing throughout other parts of the world. So, that doesn't impact you, but it is part of our raison d'etre in terms of going forward and trying to promulgate this globally.
Larry?
How much of it is aspirational? How much of it is actually something that they're committed to do? And can you cite instances where, once adopted, the language actually became something that was relevant to enforcing or going after a money manager for losses? Is there any track record where this actually forms the basis for you violated it?
No. No, there's, as I said, we are assuming that the 600 plus investment firms that claim compliance are actually in compliance. There is no verification process. We have not yet run into anything where somebody has claimed compliance and then found that they didn't and seen any kind of enforcement action. There's very little that's aspirational here. It is all basically just things that should be done, and let's say that our 105,000 plus members of the CFA Institute have all individually sign annually a code of ethics and standard of professional conduct that has these very high-level principles embedded in it. So, this is nothing new in terms of principles and the way that investment professionals should act, at least from our perspective. But it is just new in terms of providing that same imprimatur on investment firms as opposed to investment individuals.
Any further questions? What I'd like to propose is that our office will come back to the members of the governance subcommittee, because I think this is a part of the broader conversation we're already having on code of conduct policies that we want to adopt for ourselves and in turn want to adopt for those that do business with us. And so how we, in some way, perhaps endorse the CFA's efforts to encourage it because we are all aligned with it in principle is something that I'd like to come back very specifically to the subcommittee, which is the board, and to the next board meeting, having sought out our opinions, and then also would very much like to take Larry up on the suggestion, Larry Schloss up on the suggestion that we simply map what we do ourselves so that we as trustees are very comfortable that we cover all this ground, and that will give us the confidence to perhaps endorse at some level the code of conduct, but all subject for our discussion at a forthcoming meeting. Does that make sense to everybody? Great. Thank you very much.
Thank you very much for listening to me, and good luck. And if there's anything along that line that you feel we could do at CFA Institute, we're happy to.
Thank you, Chuck. Thank you for waiting.
Thank you very much.
So we have one more item on the public agenda. It is 12:15. I want to be sensitive to my trustees. We have one last agenda item for the public agenda, the Emerging Managers Program. Larry, should we just get... you want to do it? We haven't served lunch. Maybe we can serve lunch while we go through it, and then take a break for lunch? Absolutely.
I'm sorry, not to serve lunch?
Have lunch get arranged. That'll take some time, and then we...
Whatever you want to do.
How does everybody feel about that?
We can bank with it if you want before, we'll share.
Well, while they're setting up, is what I'm saying.
Before lunch, while we're doing it.
Just set up.
Okay, so don't mind the distraction.
Correct. Thank you.
Okay, well, I want to thank Pam for putting this on the agenda. As you know, we sent out a letter to the trustees and a draft resolution about emerging managers. And first we want to really acknowledge and commend the Controller's Office for all their great initiative and work on emerging managers. We know it's been an immediate commitment of the Controller, and the Controller's Office has done a lot in terms of devoting more investments and actively thinking about emerging manager policy and strategies and how to improve it. And also many other trustees on the board, the Public Advocate and Bronson and Labor have all been very especially committed to this. This is an issue that our office has been thinking about for a while. Some may recall in 2010 I brought this up briefly at a board meeting after New York State passed a law, NWBE, business and investment law, that required for the first time a broader system of accountability and transparency for monitoring its emerging managers' investments. And I broached the idea of NYCERS looking at that law and seeing whether we could adopt a policy that reflects the elements of that law, which are also policy elements that have been adopted in other jurisdictions in California, Illinois, and Maryland. So it's become what many see as mainstream policy standards, that type of accountability. So it's something that we've been thinking about for a while, and it's been a busy last year and a half or so. But we felt that the issue of emerging managers has come up a lot more recently with private equity, with federal hedge funds, and other areas. So it just seemed like a very good time to bring up the idea of a broader policy. We want to first want to thank very much the Mayor's Office, Manji and Janice and Ray for their really great edits, which strengthened this resolution and helped refine it a bit. But the gist of the resolution is to ask for a comprehensive reevaluation of the existing emerging managers policy come up with recommendations, if any, on how to improve upon it, since the current policy is pretty minimal.
Does everybody have a copy of the resolution?
No. Okay.
Can we just make a copy?
The one that's in the book, the amendment is not the most current version.
Yes, no, sorry. We only, so I believe I emailed around the latest copy to everyone yesterday afternoon, which was, sorry, a little bit late, and that incorporated, that is from the mayor's office. But I'll go ahead and, if you like, I'll go ahead and just summarize. The resolution has it talks about the great advantages of emerging managers. It's an important strategy in diversifying our investments and tapping into untapped pools of talent. And it's a very mainstream policy that's been very beneficial for us. So the resolution has four main parts. The first part is directing BAM to do a study on how emerging managers have done across all our asset classes. The second is to, thank you. And then the rest of it goes into the main goals. We want to use that study to evaluate our existing IPS on emerging managers and how that can be improved. And next, we also want to use the site to look at whether and how we can add resources that are dedicated to emerging managers that can help continually monitor, systematically monitor and evaluate our emerging manager strategies and programs. And lastly, using the policy and all the in this book to see about creating a strategic implementation plan. The specific term "strategic implementation plan," I credit the mayor's office for adding that specific term in there. I think that this reflects the very positive overall direction of the board, very much inspired by the approach of the mayor's office as well as the approach of BAM, which has been taking more of a holistic review of our investments and how to change things systemically. Emerging managers is definitely been one of the key priorities of NYCERS. NYCERS has been a leader in emerging managers ever since I've been on the board, since 2006 and before then. Again, I think everyone, it's a value that I've sensed that the whole board shares. So we think this a formal, concrete move toward seeing how we can create a better overall policy is necessary and appropriate to take this time. Fits in with all the other actions and great initiatives that the rest of the board is taking as well.
So before we get into the details of the resolution, I'd just like to update everybody on emerging managers. As you all know, John Liu is the champion of emerging managers and minority and women enterprise organizations that we all call MWBEs throughout the city as well as throughout all the retirement systems. He strongly believes in leveling the playing field and creating opportunities to compete and grow, not only the investment management side, but throughout all the branches of the city. That said, citywide, we have about $10 billion of emerging manager assets, which is about 8% of the total assets of the fund. Of that, about 62% is MWBE assets, for about $6 billion, so about 5% is MWBE assets. We've spent a lot of time in BAM trying to see how we look relative to other big pension funds, and we always come out in the top three because some people categorize some as emerging managers versus MWBEs. Whether you look at it as percent of assets or just dollars at work. If I take those numbers and then boil it down to NYCERS in particular, NYCERS has $3.8 billion of the $42 billion in emerging managers, which is 9% of the total assets of NYCERS. And then within the emerging manager category, MWBEs represent about 2/3 of that, $2.5 billion, or about 6%.
How are we defining emerging managers in that?
Emerging managers it varies by asset class, which is one of the problems you get into when you start to compare across different funds. Different funds have different definitions. So there's not one clear definition of what an emerging manager is.
Larry, the statistics you just cited, you've cited those more than a few times in our meetings. So I was wondering, could you provide us with, like a schedule? I mean, because the numbers are large, and
Yeah, we have a schedule. Easy to provide you with a schedule. In fact, I think it's part of the whole exercise without more than a schedule, but it's easy to come up with a schedule.
And I imagine it would be helpful to get uniform across our system as to what we mean when we say emerging managers.
Well, it's uniform across our system. It's just not, yes, it's just not uniform when you go outside our system and compare it to CalPERS and CalSTRS in New York State or Illinois.
Larry, can you just clarify that? It's uniform across asset classes in our system?
No, it's uniform amongst our systems.
Right.
Amongst our systems. So if we decide that, if the systems have decided in their IPSs that, I'll make up a number, but an emerging manager is a public equities manager is less than $2 billion. If that's what NYCERS has, that's what police, fire, and teachers has. But that $2 billion number that we've decided is different than the number that Wisconsin, CalPERS, CalSTRS, Florida might use. That's why comparing us to other people is complicated because everyone has a different definition. So there's not an industry definition. And I would tell you, actually, some people like it that way. For whatever their own different reasons are, they all have their own different ways of saying things. Just like something as simple as women in minority-owned businesses. You can have a different definition of that. The city has a definition. It's if women or minority businesses own more than 51% of the equity of the company. Now, that's our definition. That's the city definition. It's a different definition than other public pension funds like that. So again, comparing is a little complicated, but you kind of get to a general threshold, if you will. You can say you either have a lot or a little. So to say you're number one when you have different definitions is a little problematic, but you can rest assured, and we'll show you the numbers out, that we're clearly in the top couple.
Percent of assets.
Percent of assets and dollars. But again, now you're into the nuances of the definitions of, all right, did you cut it here and they cut it there, and the answer is yes, different definitions. So you can't really you can't compare ours to theirs. Again, if you take my example of public equities, if someone else uses $1.5 billion, it's a different number than our $2 billion. So there might be some managers in the middle that we count, they don't count. But again, so in fact, if you go to an emerging manager conference, one of the biggest topics is what's an emerging manager? But again, as long as we all have an idea of what we're trying to capture and what we're trying to say is a woman and minority owned business, I think, again, system-wide, we have an approach that we've all embraced, all boards have embraced, and then we go execute that plan. Some of the things that we've done inside BAM, again, just so you understand, we have a holistic approach to it. So we have an open door policy. Anybody who wants to get to us can get to us, subject to limitations on how many people are inside BAM and how many hours are inside of a day. So regardless of size, you can get into BAM. So that's, you now have access through this open door policy that John created into one of the largest pension funds. What we don't have, the way we set it up, is we don't have a head of emerging managers. Our view was that head of emerging managers is more of it's a non-investment position. It's a concierge, it's a political appointee potentially, and it doesn't really get you what the managers want, and what we want is we want the asset managers to talk to the asset class people directly. So we don't have a centralized head of emerging managers. We say, if you're a public equities guy, talk to SEMA. Here's SEMA. If you're fixed income, talk to Martin. Private equity, talk to Barry. Real estate, talk to Yvonne. We have each of those asset classes has an open door, and within each of the IPSs, there is a certain amount of capital that's allocated, and we can lay all that out for you. But the key is access. And I think breaking it from having a head of emerging managers to having direct access to decision makers is really what everybody wants. Now that said, we have RFP processes. So you can meet with the head of public equities, but if there's not an RFP, the meeting is interesting, but there's no opening on the street for that particular manager. Not everybody understands that, but we try to educate people on that. One of the ways we can help managers is with our Emerging Manager of Managers program, because they're always open. They have our capital, and they put it out. So we'll direct people. Again, if they come to us, we'll say we don't have an RFP for whatever you are today, a mid-cap manager. However, go talk to our emerging manager. Here's the 3 or 4 that we use. They've got our capital. Of course, there's an extra layer of fees that we pay for that. But we look at everything net. That's distinct from private equity and real estate. Each of private equity and real estate has a separate allocation for emerging managers. The way we've done it in the past is we use a fund of funds. And the fund of funds, again, it has an extra layer of fees, but historically we've done it that way. As part of the innovative procurement process that you mentioned before, Ranji, we have gone out of our way to explain to all of the emerging managers, as well as the website, if we have something coming up. If we have an RFP coming up, we talk to the emerging manager groups, which I'll get to in a second, and we also put ads in the emerging manager and MWBE trade publications to ensure that they know that an RFP is in process. We also put notices up on the controller's website. We're committed to the emerging manager and MWBE space. We attend emerging manager conferences. We also attend conferences for NASP, NAAA, AIM, CUP, NAIC, TWIGO, to name a few. We set up a dinner series for all the private equity emerging managers that are managed, or their relationship to us is through fund of funds. So we had dinners with 48 CEOs of the emerging managers, and we hooked them up. The dinners were sponsored by larger managers that we had. BAM attended, the CEOs of the small managers attended. It was hosted by one of the other managers, and it was really to talk about how can a small manager become a bigger manager, and a real open kind of conversation about how you grow your business, as opposed to how you get capital from us. That's been very well received. Last year, the Controller's Office sponsored an MWBE conference, which was really about MWBE citywide. Dan participated in that. This January, we had a day-long MWBE conference with all of our public debt and equity managers to introduce them to the MWBE brokers and ways they could work together. You may recall that last October we completed an MWBE RFI, which expanded our program by 50%. So we have 38 brokers that we instruct our managers to direct a piece of their commissions to. This has been extremely successful. It was the first time all of our public equity and debt managers actually got together with our brokers to talk about ways to work together. We accomplished this partly by what we'll call euphemistically speed dating, and it worked out great. We got great reviews and business cards were exchanged, and that worked out great. Last month we finished allocating an extra $200 million to the emerging managers and managers in fixed income. So that was additive to the system. We just started a program to try to eliminate the fund of funds fees for private equity. You may recall we have a variety of fund of funds that we use. There's an extra layer of fees. The fund of funds are the people that have the relationship then with the emerging managers. We decided we'd do it in-house. The police, teachers, and fire have approved it. We call it SEM 2012, which stands for Small and Emerging Managers. We've allocated potentially for the next $400 million of private equity capital that has funds less than $750 million. Will be done by that in that vehicle, sort of a phantom vehicle. We hired Alex Donate a couple of weeks ago to lead the program. He works for Barry. Alex comes from the Obama administration, where he served as the Associate Director of Business Development at Minority Business Development Agency, MBDA, which is part of the Department of Commerce. And he's the face of BAM and the pension funds to the small and emerging managers that are trying to raise funds less than $750 million. One success story that private equity. You may recall that last year we allocated $225 million to Vista Partners. Vista started as an emerging manager, highly successful. You'd love to have SEM 2012 have, you look back at 2015, 16, 17, have a couple of Vistas in it, because we're going to make 2+ times our capital net of fees. And they've created just a spectacular program. At the NWBE Symposium in January, the controller said that he'd like to have $500 million of additional capitals throughout the funds allocated to emerging managers, and I think that between the fixed income, the SEM, and some of the other things that we have going on, we'll definitely get to that. That said, the program as it stands now is very much asset class specific. So again, it's developed over time. It's developed over, I guess, 15 years or so. Who would know the number? Martin, you would know when it was started. 1991. So we should have had a partner. It was 20 years, 10 years, 20 years. Anyway, so after 21 years, it has kind of grown by asset class in little pieces. But having said that, it's now one of the top 1, 2, or 3 programs in the country. So if we want, we can go about study as to how the pieces are. I take your point out. You'd like to see it on a piece of paper. Easy to do, because we keep track of it every month as to how we're doing. Because again, the IPSs, depending on what they are, seek to have, depending on the IPS, up to 5% allocated to small emerging managers and MWBEs. And we could pull it all together for you pretty easily. If you want to have a big study, well, I'll defer to the board as to what you want to have in a study, as opposed to perhaps, how about we tell you what you have already. But we'll leave it up to you. But I thought it would be useful if you all to at least hear all the things that are going on. I think we'll put an extra $500 million toward that universe this year. And we spend a lot of, you should rest assured, we spend a lot of time inside BAM at the asset class level, working with these small emerging managers, whether we have an RFP, whether we have a fund of funds, whether we're taking the fund of funds in-house. And I think we've got great reach given the 30+ people inside BAM.
So I just say thank you very much. It's always really helpful to hear the great work that Controller's Office has done. It's no question the high commitment that the Controller has had to emerging managers, and you've had set a high standard for your work in that area. I think one of it would be valuable to see if we can further institutionalize a lot of the activities and strategies and programs of the Controller into formal policy, so we can ensure a lot of these things or determine whether it's valuable for the fund to see a lot of these activities continue into the future, including some of these outreach activities that you're referring to, the conferences, the mechanisms of the open door policy, etc.
So, Larry, I hear all that. Oh, sorry, please, Al.
Yeah, I want to second some of the things that Jim said. I think having a written policy for emerging managers and determining whether emerging managers should be working in asset classes for us that they're not currently working in is a very important question, which requires thought and I think a study. One of the specific areas that's been discussed is emerging managers in the hedge fund space. I think that's something that should be discussed and talked about here. The other thing I would say is that the Controller has a great commitment to emerging managers, but I have to say, being out in the field, I've heard complaints about emerging managers not being able to get phone calls returned from BAM. And I would like to see BAM improve on that, so I don't hear from emerging managers at emerging manager conferences that they can't get their phone calls returned.
Al, have you told us, have you come to us and said, please return this phone call? Or you just keep it?
No, I tell them to call you back.
But you don't call us and say, by the way, I bumped into this person?
No, I tell them to call it back.
No,
Exactly.
but you tell us, and by the way, I was at a
I will do
conference.
that. I will do that.
If you do that, we'll return their call.
Well, Larry, to be...
I don't, when you say something like that, I don't know who you're talking
To be
about.
totally honest with you, for me to call you and tell you that an emerging manager is complaining that you're not returning his phone calls, I don't know that I'm going to do that for that emerging manager.
Okay, fair enough.
But what my advice to that emerging manager has always been for them to call back again. And to call Cal or whoever the lead person is on that. And I think that with respect to expanding those classes, I think this resolution is something that I heartily support.
Jackie and then Ray?
I'd sort of like to follow on to some of what Al was saying, and first commend you for putting forward this resolution. I think it will, the steps outlined in the resolution will take the fund forward in this field, even further forward than the efforts to date have done, and obviously the efforts to date are very impressive. I do very much look forward to hearing later on today about efforts in the hedge fund space, which obviously wasn't part of your presentation, Larry, but appreciate that it will be the subject of conversation later on. One question I have, I suppose, on the steps outlined in the resolution is what is the sort of vision for a realistic time frame for completing the various steps outlined here. I'd be interested to hear a little bit more on your thoughts as well as BAM's thoughts in terms of how we can make this happen.
Well, personally, I think we have to look at the timing of other priorities of the board, the capacity of BAM. I think that's a discussion with other trustees and with BAM. So I feel that as long as the board and the trustees feel that this is feasible and can be done diligently, we can flesh out the details afterward. Perhaps we could have a subcommittee, some other discussion. So I think that we have to consider a number of factors.
Thank you. I've heard various pieces of sort of pieces of the puzzle here, all of which are very important. Al has had certain experiences with these managers, and Jimmy brings a very important perspective, and Larry gave us a presentation, and Jackie also has very good things to say. But I think it would be helpful if, in a more formal way, we would hear perhaps whatever the timeline is appropriate. Maybe it should be 3 times a year. Maybe it should be quarterly, and just have kind of a summary or analysis of where we are moving in this space. As something as simple as a conference. I didn't know until very recently that there had been a conference with these managers, and this is not to blame anyone. Simply that's an important piece of information. It's evidence of our commitment. So perhaps there is a reporting mechanism, perhaps something formalized where on a quarterly basis, 3 times a year, twice a year, it's the pleasure of the board working with BAM to decide what's appropriate, and just to see where we are so that we can see, the better to see where we are going. Because I think it's a little bit too loosey-goosey to get a presentation of the board. My note-taking is not the best, and this is no reflection on Ben, on Larry, certainly. Just to have something, perhaps a piece of paper or perhaps a short report, I think would be very helpful.
Well, we could easily, next board meeting, bring you a list and sort of peel the onion back so everyone knows what we have. That's easy to do, informative to everybody. Go by asset class, say here's where we are. Here are the managers, here are the imams, here are the fund of funds, here are the returns. Returns will be useful, no doubt. Here's how it fits to the overall portfolio. I think that'd be a way to slice it that's probably buried in these pages that everybody, I think, wants to hear.
That'd be a way to start.
Yeah, that'd be a good place to start.
And it might also be helpful, Larry and Al, in identifying where there are issues or where there is need to be improvement. And the fact that perhaps if someone has had an issue or had a problem getting back to us, I don't think that precludes us, and I know there's staffing issues for us reaching out to people proactively. Just in terms, since we are the best and we're number 1 or 2 or 3, I think that it should be kind of an ongoing thing. Communication, I think, can and should be a two-way street, not merely between the managers and us, but between us and managers.
I want to add to that by saying, Ray, it is not clear to me that we are the best. It is very clear to me listening to Larry that we are among the biggest. It is not clear to me that we are the best. I would dare say that around this table there may not be a consensus of what being the best in this space might even mean. I kept waiting for Larry to say, and here's how much value they have added for our funds. That's what this is about. That's what we're here to do. And that one line, till we understand that across the program, within each category of the program, I won't be prepared to say that we are the best. So what I would love to see in that, and people have reeled off all these things, but how much value has this program added for us? I am very clear we spend a lot of time in elected officials' offices thinking about this stuff, and it's a shared agenda. It's a shared commitment at this table. I don't think there's any question about that. But what it has done for planned beneficiaries, I am clueless. Second, I actually don't know what our strategy is. I don't know whether we think, in fact, as a board, we should pony up, find the dollars to get the people, because fund of funds is a busted strategy in this space. It doesn't work, as we've seen the proof in private equity in some detail in prior meetings. Or whether, in fact, that is a continued strategy, and whether we're doing it because we don't have resources, because we are penny wise and pound foolish, I don't know. So I actually don't know what works in this space. Our office has repeatedly said, what about, does it not work in fixed income? Where do emerging managers add value the most systematically, within which asset class? That's strategy. That's saying, let's approach this, let's agree that the commitment is all there. But let us be very thoughtful and never forget our fiduciary duty that if it does not make economic sense for beneficiaries, a lot of fantastic ideas need to fall by the wayside. So let's come back to the core discipline of what we need to do as a board. And to me, that is the study that I really heartily endorse of the entire space. And who better than us? 21 years of doing this? Who better than us to have the information? It doesn't matter whether it's this administration, good people, many members of this board have been here presiding over this. We have the proof statement. So let's look at how we've done. We have the data. We're probably rich with data more so than any other plan. So I would dare say that as a board, what we should ask is a big piece of this for the study is what resources does BAM need to do the study, because let's get thoughtful about the space. Let's get out there and say, in these spaces, for example, high-quality fixed income, emerging managers don't make sense. Let's figure out what we're not going to do as much as figure out what we are going to do. But that to me is the strategy and the study and the plan, starting with what has this done for beneficiaries. Actually, any questions at the table? Al?
Well, for the record, Ranji, I have to say, from my review, I don't know that the Fund of Funds Emerging Manager Program and public equities work. I know that some of it's not working. I would take...
So we don't know. Let's find out.
Yeah.
Let's study it. Let's look at it. But let's look at it systematically. It is very difficult as a trustee to get these ad hoc recommendations without a strategy and a policy. And if it is this big, Larry, then I'm now actually more convinced that this part of the plan needs a standalone IPS. I'm more convinced. Because it has some nuances to it. The definition issue by itself, oh my God, there's 3 pages of the IPS. I'm exaggerating to make a point. But what do we think about this so that when someone else says emerging managers and we say emerging markets, emerging managers, people are clear about what I'm not even clear what I'm talking about.
How about we do this? How about if next month we give you an update, an overview of what we have. Let's start with, here's what we have. I agree with everything you said, Ranji, about it has to make money. Is it the best use of our money? Is it the best risk return by asset class? And is it any? No disagreement. The next step to then compare us to others and best in class, all that step, if you will, developing a plan takes a lot of time and a lot of effort, and us working with talent as well as each of the asset category consultants is a big deal. From a resource perspective, I'm confident we can get you to the next board meeting with what we have. The next leap into what I'll call a big study takes a lot of time and a lot of resources. And if I look at the stuff that we're working on in-house, where we're trying to put capital out, we probably don't have the time to work on a really big project like that, because now we're talking 9% of NYCERS, right? So it's a big deal. So I would tell you it'd be something we'd love to work on during the summer when we have incremental people. Because I wouldn't want to stop whatever we're doing this other stuff, because we probably have in aggregate $6, $7, $8 billion of things in the house that we're working on. So what I'd like to do is not only come back next month with here's what we have, but also have some conversation with, let's agree on what it is we want in the report, and then set about to go do it.
Well, first of all, I think what you said, Raji, is right on the money. And without disclosing too much because we're in public session, some of the proposed changes to our emerging management program, we should not go forward with until we've done that kind of stuff.
Let's come back to that in executive session.
I also wouldn't want, just to be clear, I wouldn't want us to stop making investments in emerging managers while we're doing this stuff, right? So a lot of things that are moving along, and to just say, hey, time out, we want to wait and study, I would say is not good for the emerging managers that we have, the relationships we have, and what's in the plans, if you will.
Larry, if I can go for a second, from what I'm hearing from you is the big study. You're talking about presenting sometime in the fall, with giving us an opportunity to digest and coming back and maybe coming to some conclusions from the study 8-9 months from now.
Or sooner. I think once you have the study, the conclusion should fall out of it as to what you're going to do.
But then for us to act on it, and adopt it, or do whatever we're going to do. I think we'll go to executive session and deal with the other issues that are presented today, but I'm all for for having the study done. I'm all for having some detailed information regarding asset classes, what we have now, where we should project to go into the future, what are the risks, what are the rewards, what is the added value we would get from them, and what is the added risk that will come with it. So I think that's very productive for us to take on a big picture item. Practically speaking, I think an investment policy statement, I'm sorry, I interrupted you, and now I'm speaking generally. An investment policy statement on this is probably a good thing because 2 years from now, 3 years from now, some people on the board are not going to be here anymore. Some people on the board may be here. This may be, we may have people here on the board for the next 6 years, but if we want to do this in the future, it's nice to have it in writing so that the next step can go forward. I think that's useful. And I think that's something, that's the 8 or 9 months that I think is going to be farther down the line. I 100% agree we shouldn't start doing what we're doing now because I don't want to leave 9% of our fund in limbo, to use somebody else's phrase, while we're doing this. I think we still have to use our best efforts during that process, during this process. So let's do it a two-track way. Let's get the process moving and let's keep operating what we have to do as my suggestions.
So 2 comments from me. One is Pareto principle. I think it's an 80-20 rule, and if you can get to 80% of the study, you probably can do that in weeks, not months.
Yeah.
And I think that should be enough for us to have a better sense than we do now about the overall commitment and strategy. Second, I go back to what Jimmy said. When you come back, Larry, on timeline, strategy, etc., please go back to something you did so beautifully with us twice last year at least, which is the overall timeline for BAM. To review this without understanding everything else this same board has asked you all to do would be a mistake. Because we have to make some hard choices about what our priorities are that we are asking them to follow up on. And I don't want us to lose sight as a board the fact that we still don't have a single risk report on our tables. The fact that we haven't got someone for real assets at a broad level, look at what's happened with the bond market backup. We have real risks on the table, and I dare say that what we will find in this program is something that can use definition, use alignment so that we all are talking about the same thing when we're talking about emerging managers. But this isn't a strategy that's broken. This actually may be fine. And we have far bigger concerns that we haven't come back to focusing on because we've been looking at managers for way too long again. So I just want to ask that when we come back, when we ask Larry to come back, we come back, Larry, on that broader outline you used to give us about the next 12 months. Because without it, we can't put this into context, and we'll take 20% of your resources for something that may drive 0.5% of our return. That would not be a good use of BAM resources by this board.
Well, those plans that you referred to, which I appreciate the endorsement of, those are fiscal year plans. So the fiscal year is coming to an end.
We used to do one every 6 months, I thought.
I don't know if I had a long enough track record.
Remind us what BAM is working on, right? Remind us of what else we've asked.
By the end of the fiscal year, we'll have what we did last year, what the aspirations are for next year. So that's sort of June, probably comes out in September, I guess.
That's too far away.
I don't know if there's a board meeting in June or July. Let's wait for the numbers. Whenever the numbers are done, we come up with...
But I don't want the numbers. I'm just saying, what are BAM's priorities for 2012?
It's easy for us to walk through what we're working on, what's in process, what we've committed to, and what we're doing. So that's easy to do. Very easy to do.
Because I don't know how we tell you to go off and take resources for this without understanding what you're not going to do, because you have finite resources.
We totally have finite resources. It's extremely hard to recruit people because of the compensation levels. And people are just working as hard as they possibly can within BAM. And we are hiring people, but it's very, very difficult given that we have a very big plan, very big aggressive plan, as the board approved, I don't know, 6 to 12 months ago. We've nicked away at it, but there's some big holes and we just can't hire the people. So we haven't changed the plan. So people are just working hard to get everything done. But I'd be happy to report to you what's in process at the next meeting.
Thank you. Well, I certainly agree with everything that's been said. Are folks inclined to vote on the resolution? Should I make a motion? The chair, Ms. I'd like to make a motion to adopt the resolution.
Do I have a motion on the floor?
What?
Jimmy has a motion on the floor. Do I have a second?
Second.
All in favor?
Aye.
Any opposed? Okay, motion carried.
Resolution number 1.
So that ends the agenda for the public session.
Lunch is served.
Excellent.
So when we go into